the ICICI Prudential ET Now Value Summit, both on ground and on television, has been a resounding success. To talk about the key takeaways, what is value all about, and why value is really the key differentiating factor for ICICI Prudential AMC, I have with me Naren and Nimish. Gentlemen, first, I guess the summit both on television and on ground has been a resounding success. What's your sense?
Thank you. I think the way ET Now put it together, I think it was a brilliant concept, the way you put it across. And ultimately, the concept is so powerful. The concept is powerful and it was packaged very well. So that is why we are getting a lot of positive references from wherever we have been talking in the last 15 days.
Then I guess we were able to clearly showcase and highlight the importance of value. Value may sound boring, value may sound long term, but it can also be rewarded.
Yeah, actually Mohnish put it very clearly. If you can do 26% as he did for a decent period of time, I think 26% return is not something that most people have managed. So I think Mohnish certainly added to the entire proceedings by showing how value investing is at its heart simple way of making money, and you can afford to take afternoon naps and invest and make money. So it was very interesting.
Naren has been modest. He's saying Mohnish made 26%, but ICICI Prudential Discovery Fund, which Value Discovery Fund, which invests in the value style, also over the last 10 years, Naren has made 26% over there. That is 25 point something over there. That is, Naren is forgetting that. Huh?
But I think the government and what happened to India over the last 10 years is also responsible for it.
You know, it's easy to talk about what has happened in the past, but my question to you is that what happens next? India is a value market, but there is a frenzy in the market. Difficult time for a value investor.
There are 6,000 companies in the market. 300 companies are extensively researched, right? That is what people research, those companies. There are another 5,700 in the market. Of course, there will be value in this 300 companies also. But because of this kind of market, when somebody tells me get into private equity business, I wonder why should I get into private equity? If so many companies are already listed and I can find out, and I've got a force which can go around and find out value over there, why do I need to worry about getting into private equity when this public equity, there are so many companies left out. So because of this anomaly, where only 300 companies are researched extensively, value investing will work in India over a period of time. That's where I think Naren and his team will be able to bring out more jewels in the system. That's what.
Naren, for a market which is priced to perfection, finding value is going to be a difficult and a very difficult job.
See, it is not very difficult. In my opinion, the challenge is only what we say is the ability to be patient. Today, there are so many stocks which have good fundamentals, which have not moved from 2007 to 2014. Now, the point is some of them are connected to the energy sector, some of them are connected to the material sector, some of them are connected to the infrastructure sector. Now the question is, you've already seen 7 years of no returns, and after 7 years of no returns, those stocks have become dirt cheap. So the question is, it's pretty easy actually to buy. You have to only decide how long you think this 7 year, will that 7 year be 8 years? Will it be 9 years? Will it be 7 years and 3 months? So that's the kind of question. So I would say patience is at the heart of value investing, and I think there are always opportunities. During the heady days of 2007, there were so many cheap stocks. So as this market becomes costlier and costlier, to find value picks will become even more easy, because people will discriminate between the two and send a 40 PE stock to 60 and send a 15 or 12 PE stock to 8. Because the outperformance will increase. So the opportunities for value investing when there's a big bull run has been proved beyond doubt. So I would say it's not it's not a problem. It is just that, will this last 1 year like it happened in 2007 when, or will it be 98 to 2000? It took 3 years. That's a question which is slightly more difficult to answer.
Nimish, an average investor always approaches a mutual fund for instant gratification. And I guess the big learning in this value summit was that money will be made if you're a genuine, long-term, patient investor.
Right. The message is going across, and we need to do much more of this. That I would like to say, equity not if you don't have a 3-year paradigm.
Don't come at all.
Don't come at all in equity if you don't have a 3-year
Even
paradigm.
though that's loss of business for you, you will not advertise.
That is what I have always been saying, that at least last 6 months when the markets gave outsized returns, since then we have been going out and saying equity for 3 years, otherwise don't come. If you see the way investors are behaving when they invest in mutual fund, that is also coming out. Our average tenure has increased and now it has gone beyond 3 years. The average time an investor stays with us has gone beyond 3 years.
Why is that happening?
I think awareness is coming in. In fact, and I would say that the mutual fund industry should work more with media on our investor education. SEBI has allocated a certain budget for investor education. Rather than trying to do it ourselves in a closed room, it does not. I think investor education has to be mixed up brilliantly with media, then only it can work, because then the reach increases. If I did this ET value seminar, and ICICI Prudential ET now value seminar, if I would have done that, and if I had not had you guys, how many people would have reached vis-a-vis how many people have reached with media?
Oh, the message has been powerful, and I mean the feedback which we've got both on our Facebook platform, Twitter platform, simply is about understanding a new concept. So thank you for that.
But it's all about reach. We need a simple concept that volatility is not, volatility is an opportunity. Volatility is not equal to risk. That to explain people in Bombay, people in finance professional, people in Bombay, when they hear this, they think that I'm saying something new. Well, I thought that I was saying something very basic. So the people, even professionals in India, don't learn anytime how to invest.
I guess we managed to convey a very simple message in a very easy manner. Old message, but in a very simple manner. Then a common question which we got after the Value Summit on a Twitter platform, via SMS, via emails was, should I invest now? Am I too late? Has the train already left the station?
No, that's the beauty, no? In value investing, you pick what is cheap. And, at all points of time, something is cheap. If you go back to the old big bull runs, and I believe we are not yet in the bull run like 2000 and 2007. If you look at 98 to 2000, most of old economy was dirt cheap. And it gave beautiful returns over the next 3 to 5 years. If you see in 2007, quality was dirt cheap, and it has given brilliant returns between 2007 and 14. So in my reading, there is no time better to invest in value investing than today, except that the horizon should be, as Nimish pointed out, at least 3 years. Because if you're going to invest with a shorter time horizon, you don't know whether the current theme continues for the next 1 year or not. So I would say that as long as you're willing to invest for a period above 3 years, maybe 5 years, maybe 10 years, I think value investing works irrespective of the time of investing.
But typically, Naren, markets, they always follow a cycle, and equity returns are always very bunched up. 2 to 3 years, 3 to 4 years, that's it. Then a bear market becomes a bull market, and a bull market becomes a bear market. So for those who are planning to come now, why should they have a 5-year time frame?
Because at the end of the day, there is a cycle which is playing out, which has started in 2013. Now that cycle, in that cycle, there are sectors which are becoming cheaper by the day. From a value investing point of view, you look at what is cheap relative to value. And it normally takes some time for the cycle to reverse. If you see the 2007 cycle, it was in 2009 that a different set of companies started to go up. If you take the 2000 cycle, it was in 2002-03 that a different set of stocks started to play out. So normally there's a gap, and you can never, if I say 2 years, it could be 3 years. So what happens is you get to participate in this next move by being patient. You can't predict that the last one bull run started on 2002, another bull run started on 9th March 2009. No, was it possible to focus that you will start this bull run on 9th March 2009? The answer is no. In retrospect, I can come and tell you it started on 9th March 2009. But if I had met you on 8th March 2009, I wouldn't have known it.
But what Nimish told me in October 2013 was that the entire market was cheap. The entire market is no longer cheap.
Right.
So where do we go from here when stock picking is going to be difficult? Earlier you bought the haystack, you made money. Now it is about picking maybe those sharp needles from that haystack.
That's what is it not? It's not the same as it was in October 2013. But since there are lots of companies and lots of sectors, there are some sectors which are not in favor. Say utilities, not in favor. And can there be opportunities in utilities? There will be opportunities in utilities today. So there will be sectors which are not in favor, where the stocks are still available cheap, and we should go for those. When mid caps and large caps are at similar PE ratios, right? There can be opportunities in large cap which look at value, which 15 months back I came and tell you there are lots of opportunities in mid cap. Today I can say that with mid caps increasing out of proportion, there can be some opportunities in the large cap side also.
All right, gentlemen, stay with us. The big question, or the key question for a genuine value investor is, where is value and what about margin of safety? Naren, for an average investor is actually not an investor but a trader, the fun of investing in midcap is great because midcap as an asset class, they always promise you superior returns. But as of now, do you think the margin of safety in the midcap space is missing?
The margin of safety in large caps is much higher than the margin of safety in mid caps today. Clearly, what has happened is in mid caps, there has been no fundraising, there's been no capital raising, there's no capex. So there are no new issues. So what happens in this whole process is the amount of money which is being raised in mid caps go into the same stocks. So obviously some of the stocks have become pretty expensive. There are now some mid cap stocks which are trading at 50 and 60 times trailing. And consequently, I would say large caps today are definitely much cheaper than mid caps at this point of time. It is true, however, that if you invest for the next 3 to 5 years, the opportunity is always higher in small caps, then mid caps, then large caps.
Adding to Naren's point, if you see our value fund today, ICICI Potential Value Discovery Fund, it is earlier it was 30% into large caps, 70% into mid caps when I was telling you this. Today it is more than 45% is in large caps. 45% should be the number. Around 45% is in large caps today, vis-a-vis less than 30% in October 2013. So we also change according to.
But every bull market has a theme. Courses remain the same, but horses, they always change. If you bet on large caps now, you're not betting on tomorrow's gainers. You're betting on last cycle's outperformers.
Maybe there are spaces in large cap. Again, I'm saying, while what you say is generally true, but there will be spaces in large cap in specific sectors which still look good at the current valuation based on the intrinsic value that we have thought about those. There will be always available. As Naren said, value is always available in energy sector, in utilities. There will be still, we believe they are still available.
Why is there such a big disconnect? At a time when we are staring at a new India, Indian economy is on the cusp of a recovery, the investment cycle is yet to pick up, there are all telltale signs that corporate demand will come back. The market behavior is still tilted towards IT, consumer names and brand owners.
Yeah, actually it's surprising that the cyclical sectors haven't seen that bigger rally. I guess what has happened is because of the global developments, what has happened is the growth pickup has got postponed. My view is it's only postponed, not so what has happened, because it has got postponed, the capex cycle has got postponed, the old leaders continue to lead the market. But I think these things change, and in my reading, you're not going to have a situation where for the next 3 to 5 years only the old leaders continue to do well, because I have seen in my history, if established companies with no one-time income, they all trade at 50 times trailing. Maybe it can go to 60 times trailing. But I have seen you don't worry, and essentially value investing as a strategy is a strategy for a period about 3 years. So then you don't normally worry. So in 99, 2000, if you worried that the tech companies were trading at 100 P, can it go to 150 P? You would have not made money in value investing. In 2007, if you had worried about the infra companies trading at 100 P, will it go to 150 P? You wouldn't have made money in value investing. So that way, from a value investor's point of view, markets where there are good dichotomy in valuations actually presents itself to a much better long-term opportunity than a period where every stock seems to be fairly valued and there is not so much of difference between the different sectors. Today there's huge difference in the last 7 years between different sectors. That gives us much more opportunity in value investing.
Fair point. Nimish, a common theme at our summit was buy what you know, have an investment philosophy in place and stick to your knitting. So how would you outline your MC's thought process?
See, we have always not run away somewhere in taking a contra call. Where we stand out is that when we have a contra call, when we are convinced about it, and maybe it takes time, we are still ready to go ahead and lead and stick to it. There are a lot painful times when you don't perform as well as the market does, because you have taken a fundamental call that this is, say on FMCG, we have gone wrong on FMCG. Last 2-3 years you have been questioning us on that. Whenever I come on ET now, you question us on FMCG. We may have gone wrong on it. We have stuck to our call, right? We believe it was expensive. We believe it is still expensive, and we stayed away from it. But there are other areas where we would have made good money. So despite our funds have done well, despite not taking that particular call. So one is, once you have conviction, stick to it. Second thing, ability to take a contra call. Those are the two things that I believe. And we don't change strategy after failure. Right? Value requires that also. Once, if you have done research and if you have put your milestones there, and after that, if there is a failure on those stocks, we have the ability to live through that.
I've been told that some of the funds which you manage, they have the lowest turnover ratio in the industry. What does that mean?
Actually, we have different strategies. Some have high turnover ratios, some have low turnover ratios. See, if you are essentially from a value investor point of view, you buy for the long term. So what's the logic in having high turnover ratios? So very often you have value funds having lower turnover ratios because you bet for the long term. So, but to be honest, we have funds with higher turnover ratios as well.
What is long term?
Long term to me is a period about 3 years.
Okay.
That's what I would say is long term, because I think periods below 3 years, we think, normally we call it shorter term.
So long term is not 10 years, 15 years, 20 years. 3 years is a reasonable time frame.
Right.
And for those who are watching the show, and if they want to change their financial planning, if money is lying in fixed deposits, and if they want to change asset allocation, they should come to equities, but at least have a 3-year time frame.
Correct. And one should remember, in 3 years, this is a tax-free asset class. Mutual funds are a tax-free asset class. Why when you can get a tax-free asset class where nominal growth in the country is 12%. Obviously, the top corporates in this country will do better than the nominal growth in the country. So I don't understand the logic of investing in fixed instruments for 3 years. If you've got 3 years with you, come into mutual funds. That's what we always say.
India has managed to grow on an average at about 5% plus for last 1 decade. Yet we've seen 2 bull markets and 1 bear market. If growth is so constant, why have we seen market cycles?
But that is the difference between, as I said earlier, volatility and risk.
Okay.
In a country where the nominal growth is going to be 12%, let there be volatility. Every volatility should be an opportunity to buy. In other asset classes, say real estate, there is no liquidity available, people don't sell at all, right? So ultimately they make money because they stay for a long period of time. As long as people stay in equity for a long period of time, let the volatility, the difference is, if you take volatility as risk and you get scared on that, then you won't invest in this asset class. So one has to understand that volatility is part of game, and volatility is an opportunity and not risk. Because nominal growth of 12%, this companies over a 10-year period, like last 10-year period, markets have given a return of around 19 to 20%. Funds have given more return than that. My funds would have, like a dynamic fund would have given a 7% alpha over benchmark,
which is stunning.
In a 12 years period, right? Discovery has given us 6 to 7% alpha again over last 10 years. So if you stay over 3 to 5 years, the probability in a country like India to make more money than fixed instruments is very high.
A quick break on the show. When we come back, we'll talk about value. And after a 30% appreciation in Indian markets from the recent low, where is value in Indian stocks? Welcome back. We are in conversation with Nimisha and S. Narain of ICICI Prudential, and we are discussing nuances of value investing. Narain, typically when I talk to an average investor, everyone is of the view that stock markets means risk, stock market means lot of choppiness. However, stock market is also a hope where long-term returns could be made.
Yeah, clearly it's shown. You can see the index over a long period of time. You can see Indian index, you can see American index, you can see any index. You'll find over a long period of time they've delivered very good returns. So the point is that, the volatility part of equities will never go away because it's a well-traded asset class where the price is very clear. Whereas in many other asset classes, the price is not very clear. So therefore, what happens? The volatility is lower. So I think that's why equities work very well for the long term.
Does value investing ever work in any other asset class, or it's only confined to equities?
It works in every asset class.
Okay.
Value investing is a concept. It will work in a real estate. It will work anywhere, whatever it works.
So where is value in other asset classes right now?
Commercial real estate can be a good asset
Real
class.
estate?
Commercial, not residential real estate.
Okay.
Residential real estate is clearly very expensive and nowhere near value. But commercial real estate in India, in most of the places, of course it goes by region to region, but when the yield is around 10%, we like that asset class. In 5 years, that asset class has not given any return. People are not that, there is not a euphoria over it. So commercial real estate seems to be a good asset class.
Then where is value in this so-called volatile and choppy world?
There is value clearly today in commodities, some of the commodities. There is value clearly in long-term fixed income in countries like India. I mean, people have that 2013 in today that people still think that, fixed income is a dangerous asset class because of 2013. When you have a central bank which is so focused on inflation and financial stability, actually fixed income becomes a very much safer asset class when you have a central bank which is totally in control of both inflation and financial stability. Consequently, I think fixed income is also a very attractive asset class from a value point.
At a time when most of the big global markets are sitting at a record high, not only India, but other markets also have done rather well. Is value missing in equity as an asset class?
I'm repeating the same point I said. There will be segments in the market.
In general, I mean, when we take a top-down approach.
I know, again, when I look at equities will always have opportunities in different segments, in different sectors. The sector which has not done well over the last 1 or 2 years are the sectors which will always offer value. So I can see value in, as I said earlier, in utilities, in energy, in some of the banking stocks. There is clear value.
You've always believed in the theory of betting on fear, buying uncertainty. Identify those spots for us.
Clearly, I think junk infra stocks where you can research commodities of different
You will not
use.
buy commodities, but I mean, in a fund you cannot buy commodities. You have
No,
to
but
buy metal stocks.
but stocks based on commodities,
Okay.
whether it is in metal, energy, all these sectors. I think these are all some of the areas where clearly you can see fear at this point of time. And other than that, frankly, you don't see that much of fear for the short run. But in most markets, for you to shift from greed to fear sometimes happens in 3 months.
Yes.
So that's why while today we may be talking about greed, but you can have a different situation in the month of March. So that's why we'll keep getting opportunities. As long as you're a long-term investor, you will keep getting opportunities.
18 months ago, it was not fear, it was panic. And there were definitions or all theories going around that India is passé now and it does not deserve to be part of the BRIC nomenclature. But look at what has happened. Outside the scope of this value conference, let's talk about your market outlook for 2015. For those who are investing with mutual funds, what should they expect? Should they expect higher volatility? Should they expect greater degree of outperformance?
Indian mutual funds overall has done well. A lot of mutual funds in this country, a huge percentage has given outperformance over benchmark. So that there is not a challenge. But the investors have seen a huge return in the last 18 months, right? The expectations are very high. When people come to invest in mutual funds, their expectations need to be mellowed down. They have to be very clear that it is going to take 3 to 5 years to get the kind of returns that have come in the last 18 months, last 15 months. So that expectation setting is very, very important. Earnings have to grow. We believe now the markets are not cheap. Markets are fairly valued. So there is nothing cheap available in the market, as I used to come and say 15 months back. Value will be in growth. Value will be in companies which are going to grow. And it requires a lot of work now. The way money is going to be made in the next 3 years is very different from the way money was made in the last 3 years. So they should come only with a mindset of 3 years. Less than 3 years, please don't come to equity, or please don't even come to mutual funds if your paradigm is less than 3 years. That's a message we have been consistently giving.
Nimesh, Naren, it was fantastic to have you on the show, and it was great partnering with your AMC. I certainly a lot about value investing, and I'm sure our viewers would have also benefited equally.